All right, so, when you're thinking about planning for the future, like retirement, and all of a sudden it feels like you're drowning in financial jargon.
Absolutely. It can be overwhelming trying to decipher all those terms.
You know what I mean?
Yeah, for sure.
It's like you shared something with us, Chapter 9, annuities.pdf, and we thought it was a perfect opportunity to really dive into one of those financial tools that might seem a bit complicated on the surface, but that are pretty crucial to understand.
Annuities, yeah, they often get lumped in with other complex financial products,
Yeah.
but they're really not as intimidating as they might seem at first glance.
Not at all. So, in this deep dive, we're aiming to make annuities crystal clear for you. We want to lay out the key ideas, what they're meant to do, how they work, and the different flavors you might come across.
Exactly. We'll try to unpack the jargon, highlight the most interesting bits, and by the end, you should have a solid grasp of annuities without getting bogged down in the nitty-gritty.
Precisely. So you gave us this chapter, and we want to make sure you walk away with a clear understanding of what annuities are all about and why they might or might not be relevant to your financial goals.
A great way to think about it is this. They're designed to provide you with a source of income later on in life.
Okay, so income for the future. But let's take a step back. What exactly is an annuity in the big picture?
Well, at its core, an annuity is a contract that you make with an insurance company. Its fundamental purpose, as the chapter points out, is to protect you against the possibility of outliving your income. That's a real concern for many people, having enough money to last throughout retirement.
Right, because you don't know how long you're going to live and you don't want to run out of money, especially when you're no longer working.
Absolutely. So think of an annuity as a way to save for the future, and then, interestingly, as the chapter puts it, the liquidation of an estate.
Liquidation of an estate. Now, that's an interesting phrase. What does that mean exactly?
It means essentially how you use the assets you've accumulated during your lifetime to support yourself in retirement. And this is a key contrast with life insurance, which the chapter describes as the creation of an estate for your beneficiaries.
Okay, so one is about building up for others, the other about managing what you've built for yourself. That's a good way to put it. And, another thing that struck me from the chapter is that you don't usually need to prove you're insurable to buy an annuity, which is different from life insurance, right?
You got it. With life insurance, the insurance company is trying to gauge the risk of having to pay out a death benefit. So your health and medical history are important factors. But with an annuity, the focus is on providing you with income down the road. So things like your medical history typically aren't a factor.
Makes sense. So you don't have to jump through those same hoops. Now, the chapter mentions that an annuity has a sort of life cycle with two main phases. Can you walk us through those?
Sure. First, you have what's called the accumulation period. This is the phase where you put money into the annuity and it has the opportunity to grow.
Okay, so like the saving up phase, and then what's the second phase?
Then comes the annuity period, which is also known as a payout phase. This is when you start receiving income from the annuity.
Okay, so contribute funds, let them grow, and then start receiving payments. Pretty straightforward so far. What are some of the advantages during that first phase, the accumulation period?
Well, one of the biggest perks the chapter highlights is that the money you put in grows on a tax-deferred basis,
Tax deferred meaning?
meaning you don't have to pay taxes on any earnings until you actually start taking the money out. It's like giving your savings a turbo boost because you're not losing a chunk to taxes every year. The power of compounding, as they say.
So more money staying invested and potentially earning even more over time. Now, the chapter also touches on something called qualified and non-qualified annuities. Can you break those down for us?
Sure. So qualified annuities are often funded with pre-tax dollars, meaning you get a tax deduction for the contributions. These are often set up through employer-sponsored retirement plans like 403Bs. Those are the ones typically offered to folks working in public schools and nonprofit organizations, as mentioned in the chapter.
Okay, so those are directly linked to retirement savings. What about non-qualified annuities?
Non-qualified annuities, on the other hand, use after-tax dollars. You don't get an upfront tax deduction for the contributions, but here's the catch. Any interest you earn still grows tax-deferred until you withdraw it.
So even though you've already paid taxes on that money, the growth within the annuity is still sheltered from taxes until you access it.
Interesting. Now let's talk about how you actually put money into these annuities. The chapter talks about different ways you can pay premiums. What are the main options? You've got two main paths: a single premium or periodic premiums. A single premium annuity, as the name suggests, involves making one lump sum payment up front. And once you've made that initial deposit, you generally can't add any more funds later on. It's like taking a chunk of money you have and deciding to transform it into an annuity all at once.
So that makes sense if you have a significant sum of money available, maybe from an inheritance or a sale of property.
Exactly. Now, if you prefer to spread out your contributions over time, you can opt for periodic premium annuities. This means you make multiple payments, and there are two flavors within this category: level premium and flexible premium.
Okay, let's break those down. What's a level premium annuity?
With a level premium annuity, you make consistent payments at regular intervals, maybe annually, until you decide to start receiving income. The chapter gives the example of someone paying a fixed amount every year from age 35 until retirement. It's like setting up a regular savings plan.
Like clockwork. And what about flexible premium annuities? How do they differ?
Flexible premium annuities give you more freedom. You can contribute different amounts at different times, as long as you meet any minimum requirements set by the insurer. This is really handy for people whose income might fluctuate, or for those who want the flexibility to adjust their contributions based on their circumstances each year. The amount you save through these flexible payments will then determine the income you'll receive later.
That adaptability sounds really useful, especially for people who might have unpredictable income streams or changing financial needs. So you've put your money in, it's potentially growing tax deferred. Now, the big question is, when do you get to access that money?
Good question. Annuities can be categorized based on when that payout phase starts. There are immediate annuities and deferred annuities. An immediate annuity is designed to start paying you income very soon after you buy it, typically within a month. You fund it with a single lump sum, and then boom, the income stream starts almost right away. There's no real accumulation period since you're not waiting for the money to grow. It's about immediate income.
So if you need income right away, like for supplementing your retirement income, or if you become disabled and need a reliable source of funds, an immediate annuity might be a good fit.
Precisely. Now, on the flip side, you have deferred annuities. As the name suggests, there's a time lag between when you buy the contract and when you start receiving payments. This type has a significant accumulation period where your contributions can grow tax-deferred, often for many years. It's all about building up a nest egg for the future.
Okay, so you're delaying gratification, letting that money grow tax-free, and then accessing it later on, usually for retirement. And what happens when you're ready to access the funds in a deferred annuity? Does the chapter talk about the options you have?
Yes, it does. The chapter outlines three main choices. You can take a lump sum distribution, but remember, you'll have to pay taxes on any interest earned at that point.
Makes sense. What are the other options?
You could choose systematic withdrawals, where you take out a certain amount at regular intervals, like monthly or quarterly. This can be a good way to create a steady stream of income. Or you can convert the accumulated funds into an income stream, essentially kicking off the annuity phase and receiving regular payments, typically monthly, for the rest of your life.
So you have some choices in how you access that money, depending on your needs and preferences. We've talked about how you fund annuities and when you can access the money. Now let's get to the heart of it. Where does that income actually come from? The chapter makes a key distinction between fixed and variable annuities. What's the fundamental difference between these two?
That's a crucial distinction. A fixed annuity guarantees a set income payment amount that you'll receive regularly, usually monthly, for as long as you live. These are linked to the insurance company's general account assets, which provide the interest rate guarantee and the promise of that fixed income.
So it's all about predictability and knowing exactly how much income you'll receive.
Exactly. As long as the insurance company is financially sound, you're guaranteed that specific income stream. The insurer takes on the investment risk, so you don't have to worry about market fluctuations impacting your payments.
That peace of mind is definitely a big plus, especially for folks approaching retirement who want that stability and certainty. But what's the trade-off?
Well, the potential downside is that the purchasing power of those fixed payments could erode over time due to inflation. It's that classic battle between predictability and keeping up with the rising cost of living.
So you have to weigh that security against the possibility that your income might not stretch as far in the future.
Got it. Now, what about variable annuities? How do they work?
Variable annuities take a different approach. They offer the potential for higher returns, but also come with the possibility of losses. The money you pay in isn't added to the insurer's general account like with a fixed annuity. Instead, it's invested in what's called a separate account, typically invested in securities like stocks and bonds.
So there's a direct link to the stock market. Yes, and that means you, the contract owner, assume the investment risk. Your income in retirement won't be a fixed amount. Instead, it will fluctuate based on how those investments in the separate account perform. If the market does well, your income could potentially increase. But if the market takes a downturn, your income could decrease. It's more potential upside, but also more risk and uncertainty.
Higher potential reward, higher potential risk, the classic investment trade-off. And I noticed the chapter mentioned F&R registration for anyone selling variable annuities. Why is that?
Because of the nature of variable annuities, they're considered securities, which means they fall under the oversight of the Financial Industry Regulatory Authority, or FINRA. Anyone selling them needs to have the proper securities licenses, typically a Series 6 or Series 7 registration, on top of their state insurance license. This ensures that the people recommending these products have a certain level of knowledge and expertise about securities and the risks involved. And just like with other securities, they're required to provide a prospectus to potential buyers before the sale is finalized. This document outlines all the important details about the investment options and potential risks, ensuring transparency for the investor.
So it's all about investor protection and making sure people understand what they're getting into. The chapter also mentions sub-accounts within variable annuities. Can you elaborate on those?
Yeah, the separate accounts within variable annuities usually have a range of underlying investment portfolios, called sub-accounts. Think of it like choosing from a menu of different mutual funds with varying investment styles. You, the contract owner, get to decide how to allocate your premium payments among these sub-accounts. You can even transfer money between them as your goals change or market conditions shift during the accumulation phase. Some sub-accounts might focus on large-cap stocks, while others might invest in bonds or money market instruments, each with its own risk and return profile. The chapter even mentions that some variable annuities might offer a fixed-rate sub-account, essentially providing a guaranteed rate of return within the overall variable annuity structure. It's like having a little bit of everything under one roof.
So you have some control over how your money is invested within the annuity. Now, how does the actual income payout work when you reach the annuitization phase of a variable annuity?
Well, when you decide to start receiving income, the insurance company takes the accumulation units you've built up during the accumulation period and converts them into what are called annuity units. These annuity units are essentially a way to calculate the dollar amount of each payment you'll receive. The number of annuity units you get is fixed at the start of the payout phase, but the dollar value of each unit fluctuates based on how the underlying investments in the separate account perform. It's like having a fixed number of slices of a pie, but the size of each slice changes depending on how well the whole pie grows or shrinks.
Okay, so the number of units is fixed, but their value can go up or down depending on market performance. That makes sense. Now, we've covered where the income comes from. Let's talk about the different ways you can actually receive those payments. The chapter dives into various settlement options. Can you walk us through some of the main choices?
Absolutely. There are quite a few options, each with different implications for you and any beneficiaries you might name. One of the most common is the straight life annuity, sometimes called a pure life annuity. With this option, you receive payments for the rest of your life, but the payments stop completely when you die. Nothing goes to your beneficiaries.
So it's maximizing your income for as long as you live.
Right. It's designed to protect against superannuation, which is essentially the risk of outliving your income. The chapter even mentions that life expectancy plays a role in the payment calculation. For instance, a man might receive higher monthly payments than a woman of the same age because, statistically speaking, men tend to have shorter lifespans. So you might get a larger monthly payment, but there's no guarantee of any residual benefits for your heirs.
So it's a trade-off between maximizing your income and potentially leaving something behind for your loved ones. What are some other ways to receive payments?
Another option is an annuity certain, or period certain. This guarantees payments for a set period of time that you choose, say 10 or 20 years. It doesn't matter whether you're still alive or not, those payments will continue for the entire specified period. If you die before the end of the term, your beneficiary receives the remaining payments. But if you outlive that period, the payments stop. It's a way to secure income for a defined period, whether you're around or not.
So it provides income security for a specific time frame, and there's an option that combines elements of both of those, right?
You're thinking of a straight life annuity with period certain. This is where things get interesting. You get income for life, but if you pass away before the end of the chosen period, let's say 15 years, your beneficiary will continue to receive payments for the remainder of that 15-year term. It's a nice balance between ensuring income for your lifetime and providing a safety net for your loved ones if you happen to die sooner than expected.
I can see why that would be a popular choice. It offers peace of mind for both you and your beneficiaries. Now, the chapter also dives into how many people an annuity can cover. Can you explain the different types based on the number of lives?
Sure. You have individual or single life annuities, which we've already talked about with the straight life option. These cover just one person. Payments are made for that person's life and stop when they die.
And what about annuities that cover more than one person?
For that, you have two main options: joint life annuities and joint and survivor annuities. A joint life annuity covers two or more people, but the payments end when the first annuitant dies. It's designed to provide income while both individuals are living, and it stops after the first death.
Got it. So it's for when the need for income is primarily while both people are alive. And how does the joint and survivor annuity work?
A joint and survivor annuity also covers two or more people, but it continues paying until the last annuitant dies. It's often chosen by married couples to ensure that the surviving spouse continues to receive income. The chapter mentions there can be variations like a full survivor option, where the survivor gets the same payment amount, or a reduced option, where the payment is smaller after the first death. It's all about providing long-term income security for a couple.
That makes a lot of sense for couples planning for their future. Now let's circle back to the accumulation period. When exactly does that phase end?
Good question. The accumulation period, that pay-in phase, ends when a few different things happen. It ends if the contract owner dies, if the annuity or payout phase begins and income payments start, or if the policy is surrendered, meaning you decide to cash it out. Interestingly, the chapter notes that simply missing a premium payment doesn't automatically end the accumulation period. The contract might stay in force, but the growth might be affected.
So it's not an all or nothing scenario with missed payments. Okay, during that accumulation period, who are the main players involved in the annuity contract?
The chapter identifies four key roles. You have the insurer, which is the insurance company issuing the annuity. Then you have the contract owner, who's the person or entity buying and funding the annuity. They have the right to name the beneficiary and decide whether to surrender the policy.
So the owner is in the driver's seat.
Exactly. Then you have the annuitant, who's the person who will receive the income payments once the annuity phase begins. This could be the same person as the owner, or it could be someone else.
Makes sense. And who's the fourth player?
And finally, the beneficiary. The beneficiary receives the annuity's value if the owner dies before the annuity phase starts, or if there are any remaining payments due after the annuitant's death, depending on the chosen settlement option.
All right. So those are the key roles. Now, let's say you need to access your money early from a deferred annuity. What happens then? The chapter talks about surrender charges. Can you explain what those are?
Surrender charges, also known as back-end loads, are essentially penalties you might have to pay if you take money out of a deferred annuity before a certain period has passed. They typically kick in if you withdraw more than a specified percentage, usually around 10%, in a single policy year. And if you decide to cash out the whole annuity early, these charges are deducted from the annuity's value. The good news is that they usually decrease over time, gradually going down to zero after a certain number of years, as outlined in the contract. The chapter even gives an example where a charge of 8% in the first year might decrease by 1% each year for the next 8 years. So the longer you hold the annuity, the lower the penalty if you need to access your funds early.
So it's a way to encourage you to keep your money invested for the long haul. And these surrender charges are different from any tax penalties for early withdrawals, right?
You got it. They're completely separate. Surrender charges are imposed by the insurance company to recoup some of their costs if you exit the contract early. The IRS, on the other hand, might hit you with a 10% penalty tax on withdrawals made before age 59.5 from a deferred annuity.
So you could end up paying both a surrender charge to the insurance company and a tax penalty to the government if you withdraw money early. That's definitely something to keep in mind. Now, the chapter also mentions non-forfeiture values. What does that refer to?
Non-forfeiture value is basically the amount of money you'd receive if you surrendered the annuity before the payout phase begins. It's calculated by taking your total premiums paid, adding any interest earned, subtracting any previous withdrawals, and then deducting any applicable surrender charges. It's the net amount you're entitled to if you decide to cash out.
Got it. It's the current accessible value of the annuity before you start receiving those regular income payments. Now, the chapter highlights a particular type of annuity that seems to be quite popular: flexible premium deferred annuities, or FPDAs. What makes them so widely used?
FPDAs offer a great combination of attractive features. They give you the flexibility to make variable premium payments over time. They're designed to provide income later on. And most importantly, they offer tax-deferred growth on any interest earned. They've essentially replaced older types of annuity contracts that were more rigid and often came with higher upfront fees. While FTAs might have those back-end surrender charges we discussed earlier, they typically have low or no upfront sales charges. This makes them very appealing for folks saving for retirement.
So it's that flexibility, tax deferral, and generally lower costs that make them popular choices. The chapter also touches on single premium immediate annuities, or SPIAs, which we've already talked about a bit, and single premium deferred annuities, or SPDAs. What's the main difference with SPDAs?
A SPDA, like a SPIA, is funded with a single lump sum payment. But the key difference is that the income payments are delayed to a future date. You put the money in, it grows tax deferred for a period of time, and then you start receiving income later on. The chapter also points out that some SPEAs might have a bailout provision.
Bailout provision. Tell me more about that.
A bailout provision allows you to withdraw your funds without those pesky surrender charges if the interest rate offered by the annuity drops below a certain level specified in the contract. It's like a safety net in case the annuity isn't performing as well as you'd hoped.
Ah, so it's a way to potentially exit without penalty if the interest rates become unfavorable. That's a nice feature to have. The chapter also briefly mentions older annual premium retirement annuities. What can you tell us about those?
Those were a more traditional type of annuity that required fixed annual premium payments. The chapter notes that they often came with higher upfront fees compared to the more flexible FPDAs we talked about earlier. While they still offered tax-deferred growth, those higher costs made them less competitive over time, so you don't see them as often these days.
So the newer types of annuities tend to be more flexible and cost-effective. Makes sense. The chapter also briefly describes annuity riders. What are those?
Riders are optional add-ons that you can purchase for an extra cost to enhance your annuity contract with specific features or benefits. The chapter gives a few examples. There are long-term care riders, which can help you access part of your annuity's value if you need long-term care services. There are guaranteed minimum withdrawal benefit riders, or GMWBs, which guarantee a certain percentage of your initial investment can be withdrawn each year, regardless of how the investments perform. Then there are guaranteed minimum income benefit riders, or GMIVs, which ensure you'll receive a minimum income after annuitization, again, regardless of investment performance. And finally, there are guaranteed minimum accumulation benefit riders, or GMIBs, which guarantee a minimum value for your premiums after a specific period. These riders can offer a variety of protections and guarantees, but remember they come with additional fees, so you need to weigh the cost against the potential benefit they provide.
So it's like customizing your annuity with extra features to suit your specific needs and risk tolerance. Now, the financial world is always evolving. The chapter touches on some newer types of annuities like equity indexed annuities and market value adjusted annuities. Let's explore those. What are equity indexed annuities, or EIAs?
An EIA is a type of fixed annuity, so it offers principal protection, unlike a variable annuity. But what sets it apart is that the interest you earn is linked to the performance of a particular market index, such as the S&P 500.
So you get some exposure to the stock market without the risk of direct investment.
Precisely. You're not actually investing directly in the index. The way it works is that you have a guaranteed minimum interest rate to protect you on the downside, and then you have the opportunity to earn additional interest based on a percentage of the gains in that linked index over a specific period. That percentage is called the participation rate. So you can potentially participate in market growth without the risk of losing your principal if the market goes down. It's kind of a middle ground between the safety of a fixed annuity and the potential growth of a variable annuity.
That sounds appealing for someone who wants growth potential but is also concerned about preserving their capital. Now, what about market value adjusted annuities, or MVAs?
An MVA is a type of deferred annuity that gives you a fixed interest rate for a set period, usually several years. The unique thing about MVAs is that if you surrender the annuity before that guaranteed rate period ends, the amount you get back might be adjusted based on the market value. This adjustment can either increase or decrease your payout depending on how interest rates at the time of surrender compare to the rate you locked in when you bought the MVA. The chapter compares it to bonds. If interest rates have dropped since you bought the MVA, your adjustment might be positive, giving you a bit more. But if rates have gone up, the adjustment might be negative and you might receive less. However, if you hold on to the annuity for the entire guaranteed period, it acts like a regular fixed annuity and you get the guaranteed rate without any market value adjustments. So there's some interest rate sensitivity if you need to cash out early.
Interesting. It's like a hybrid between a fixed annuity and a bond, with potential benefits and risks depending on how interest rates move. Now let's shift gears a bit. why would someone consider buying an annuity in the first place? What are the main uses for them?
The chapter emphasizes that the primary use of annuities is to provide income during retirement. It's a way to create a structured approach to drawing down your savings and ensure that you have a steady stream of income that can last for your lifetime. Remember, while life insurance is about creating an inheritance for your beneficiaries, annuities are about using your assets to support yourself during your lifetime. The chapter also mentions using annuities to fund IRAs and other qualified retirement plans like KEO plans, SEPs, and 401ks.
So they can be a valuable part of your overall retirement planning strategy. And I remember the chapter specifically talked about tax-sheltered annuities or 403(b) plans. What's the story with those?
Tax-sheltered annuities, or TSAs, also known as 403(b) plans or 501(c)(3) plans, are a specific type of retirement plan designed for employees of nonprofit organizations, public schools, and certain other tax-exempt entities. The key benefit here is that contributions to these plans, whether made by the employer or the employee, can be excluded from the employee's current taxable income. And then when you retire and start receiving payments from those TSAs, that income is treated as ordinary income for tax purposes. The idea is that your tax bracket might be lower in retirement, so spreading those payments out can help manage your tax liability.
So it's a way for certain employees to save for retirement using pre-tax dollars. The chapter also mentioned using annuities for structured settlements. What are those all about?
Structured settlements are arrangements where, instead of receiving a big lump sum payment, maybe from a legal settlement or a lottery win, the money is distributed over time through a series of payments. Annuities are a great fit for this because they can be tailored to the specific needs of the person receiving the settlement. For example, they can provide a steady income stream to cover ongoing medical expenses. Similarly, for those huge lottery wins, the lottery commission might use an annuity to fund those long-term prize payouts, ensuring the winner receives a regular income stream for many years.
So it's a way to create a predictable and often tax-advantaged stream of income over time. And I think the chapter briefly mentioned using annuities for education funds as well.
Yes, while retirement is the primary focus for most annuities, they can be used for education purposes too. For example, you could set up an annuity to create a stream of income that could help pay for a child's or grandchild's college tuition.
Okay, so annuities can be a versatile tool with a variety of uses, but how do you know if an annuity is right for you? The chapter emphasized suitability. What does that mean in this context?
Suitability is absolutely critical. It means that any recommendation to buy, sell, or exchange an annuity must be appropriate for your individual financial situation, your goals, and your risk tolerance. Annuities aren't a one-size-fits-all solution, and there are many factors to consider. The chapter lists a whole bunch of them: your age, your income, your overall financial situation, your financial experience, your specific objectives, how you plan to use the annuity, your time horizon for needing the money, your existing assets, your liquidity needs, your net worth, your comfort level with risk, and your tax status.
Wow, that's a lot to take into account.
A responsible financial advisor will carefully evaluate all these factors before recommending an annuity. And speaking of protecting investors, the chapter mentioned that there's extra scrutiny when annuities are recommended to seniors.
Why is that?
Because seniors are often retired or nearing retirement, their financial needs and priorities might be different. They may have a shorter time horizon for their investments, they may need more guaranteed income, and they may be more focused on preserving capital. To protect this vulnerable group, regulators have put in place stricter rules for annuity recommendations to people 65 and older. Financial professionals have to make a reasonable effort to gather detailed information about the senior's finances, tax situation, and risk tolerance to ensure the recommended annuity is truly suitable.
It's great that there are these safeguards in place to protect seniors. And finally, let's talk about the elephant in the room: taxes. The chapter has a whole section on annuity taxation. Can you summarize the key tax implications?
Well, as we touched on earlier, contributions to qualified annuities, like those held within retirement plans, are usually made with pre-tax dollars, meaning they can be tax deductible. Contributions to non-qualified annuities, however, are made with after-tax dollars. But regardless of the type, the earnings within the annuity grow tax-deferred. And when you start receiving payments, those payments are generally treated as part principal, which is not taxed if it's a non-qualified annuity, and part earnings, which are taxed as ordinary income.
And I remember the chapter mentioned something called the exclusion ratio. How does that work?
The exclusion ratio is a formula that determines how much of each payment you receive is considered a tax-free return of your original principal, and how much is considered taxable earnings. It's basically your total investment in the annuity divided by your expected total return, which is your annual payment multiplied by your life expectancy at the time you start receiving payments. The resulting percentage is the portion of each payment that you can exclude from your taxable income. The chapter gives a helpful example. Let's say you invest $100,000 and you're receiving $7,500 per year with a life expectancy of 20 years. The exclusion ratio would be 67%. This means that $5,025, 67% of $7,500 of each payment would be tax-free, and the remaining $2,475 would be taxed as ordinary income. Okay, so the exclusion ratio helps ensure you're not taxed twice on the money you initially invested. Now, what happens if you need to withdraw money early from a deferred annuity before those regular payments start? The IRS isn't a fan of using deferred annuities as short-term investments, so they impose penalties on early withdrawals, typically before age 59 and a half. Those withdrawals are generally taxed using the last in, first out, or LIFO method, meaning any earnings are considered to be withdrawn first and are taxed as ordinary income. There's an exception for annuities bought before August 14, 1982, which use a first in, first out, or FIFO approach, meaning your principal is withdrawn first. And on top of the regular income tax on those earnings, you'll usually get hit with a 10% penalty tax as well.
Yikes. So early withdrawals can be costly from a tax perspective. Are there any exceptions to that penalty?
There are a few exceptions, such as cases of disability or death, or if the funds are from a qualified pension plan. It's always best to consult with a tax advisor regarding your specific situation.
Definitely. Now, what happens to an annuity if the owner dies before the payout phase has begun?
In that case, the named beneficiary on the contract receives the accumulated value of the annuity, which includes the total contributions plus any interest earned up to that point. It's important to note that any amount the beneficiary receives that's more than the original premiums paid in is considered taxable income. But there might be some options for the beneficiary to reduce the tax impact.
Oh, like what?
For instance, they might be able to choose to receive the funds as a life income stream or in installments over time, rather than as one big lump sum, as long as they make that choice within 60 days of the owner's death. This can help spread out the tax liability over a longer period.
Good to know there might be some flexibility there. The chapter also mentioned something called 135 contract exchanges. Can you explain what those are?
A 1035 exchange allows you to swap one annuity contract for another without triggering a taxable event at the time of the exchange. You can also exchange a life insurance policy or an endowment contract for an annuity, but you can't go the other way around and exchange an annuity for a life insurance policy tax-free. The key is that the funds have to be transferred directly between the contracts. You can't receive,